participatory currency a central exchange rate against a basket of currencies, the European Currency Unit (AQ). Participants, initially France, Germany, Italy, the Netherlands, Belgium, Denmark, Ireland, and Luxembourg, were then required to maintain their exchange rates within a 2.25% fluctuation band above or below each bilateral central rate. The ERM was an adjustable peg system, and 9 realignments would occur between 1979 and 1987. While the United Kingdom was not one of the original members, it would eventually join in 1990 at a rate of 2 German marks and 95 pfennigs to the pound and with a fluctuation band of plus or minus 6%. Until mid-1992, the ERM appeared to be a success, as a disciplinary effect had reduced inflation throughout Europe under the leadership of the German Bundesbank. The stability wouldn't last, however, as international investors started worrying that the exchange rate values of several currencies within the ERM were inappropriate. Following German reunification in 1989, government spending surged, forcing the Bundesbank to print more money. This led to high inflation and left the German central bank with little choice but to increase interest rates. However, the rate hike came with consequences as it placed upward pressure on the German mark. This forced other central banks to raise their interest rates as well as to maintain their pegged currency exchange rates, a direct application of Irving Fisher's interest parity theory. Realizing that the UK's weak economy and high unemployment rate would not permit the British government to maintain this policy for long, George Soros stepped into action. Soros bets against the success of UK involvement in the ERM. The quantum hedge fund manager essentially wanted to bet that the pound would depreciate because the United Kingdom would either devalue the pound or leave the ERM. Thanks to the progressive removal of capital controls during the EM's years, international investors at the time had more freedom than ever to take advantage of perceived disequilibria, so Soros established short positions in pounds and long positions in marks by borrowing pounds and investing in mark-denominated assets. He also made great use of options and futures. In all, his positions accounted for a gargantuan $10 billion. Soros was not the only one, many other investors soon followed suit. Everyone was selling pounds, placing tremendous downward pressure on the currency. At first, the Bank of England BoE tried to defend the pegged rates by buying £15 billion with its large reserve assets, but its sterilized interventions whereby the monetary base is held constant thanks to open market interventions were limited in their effectiveness. The pound was trading dangerously close to the lower levels of its fixed band. On September 16, 1992, a day that would later be known as Black Wednesday, the bank announced a 2% rise in interest rates from 10% to 12% in an attempt to boost